Good afternoon, and thank you for joining us for today's National Conference of State Legislatures webinar, COVID-19, Lending to American Consumers. My name is Representative Adam Koenig from Kentucky, Vice Chair of the NCSL Communications, Financial Services, and Interstate Commerce Committee, and I'll be your moderator for today. This is the second webinar in the CFI Committee COVID-19 webinar series. The last of our three webinars will be about credit reporting and consumer data in the age of COVID-19 and will take place on Wednesday, July 29th. For a complete schedule and registration details, please visit our website at ncsl.org. Before I introduce our speakers, I want to review a few housekeeping items. Today's webinar is a platform for information exchange and engagement. Over the next 60 minutes, we encourage participation through our chat box. So feel free to type your questions and answer any questions in the chat box on your screen. To begin building some comfort with the chat function and also to learn who is online today, I invite you to type in the state from which you are calling now. We will hold a formal Q&A after our presenters are finished presenting. Many of you will want to download the slides for today's webinar. You can find a PDF version of the slides by opening the tab labeled Resources. The tabs are found just above the presentation window. Another tab is labeled Speaker, where you can read the bios of today's speakers. You can access these tabs at any time during the presentation. If you have trouble downloading the presentation, please email Trey Shork, our CFI committee staff, at tres.york@ncsl.org, and he will send you a deck of the slides. The webinar platform we are using is optimized for use in Google Chrome. We recognize anyone experiencing technical difficulties, try signing in through Chrome instead. If you continue to experience technical issues, please email registration@ncsl.org, where our team is ready to assist you. Today's webinar is being recorded and will be available on NCSL's website within the week. The National Conference of State Legislatures is the bipartisan organization that serves the legislators and legislative staff of the states, commonwealths, and territories. NCSL provides research, technical assistance, and opportunities for policymakers to exchange ideas on the most pressing state issues and is an effective and respected advocate for the interest of the states in the American federal system. NCSL developed a webpage to house our comprehensive resources on the state and federal response to COVID-19. Here you can find a database with up-to-date real-time information about bills related to and responding to COVID-19 that have been introduced in the 50 states, Puerto Rico, Guam, and the District of Columbia. Archives of previous webinars, information on state policies and response related to continuity of government, and other important considerations during this unprecedented time. Now that the housekeeping details are out of the way, let's get back to why we are here. Joining us today are Laura Udis with the Consumer Financial Protection Bureau, Alex Horowitz with the Pew Charitable Trusts, and Mary Jackson with the Online Lenders Alliance. First up, we have Laura Udis. Laura is the Small Dollar Marketplace and Installment Lending Program Manager in the Consumer Financial Protection Bureau's Research, Markets, and Regulations Division. She joined the Bureau in 2013. Prior to that, she served in the Colorado Attorney General's Office as the administrator of the Consumer Credit Code from 1988 to 2013. Laura has a JD from Boston University School of Law and a BA from the University of Colorado. Laura, thank you so much for joining us today, and the floor is now yours.
Thank you very much. I'm happy to be with you today. And as you heard, I have some experience with state government and also working with state legislatures. So first I need to say that the presentation today that I'm making, while I'm making it on behalf of the CFPB, does not constitute legal interpretation, guidance, or advice of the CFPB, and any opinions or views stated are my own and may not represent views of the Bureau. I have just this one slide for you today, and I'll refer to it once or twice. Otherwise, I will just be speaking with you. So first of all, I want to recognize that, of course, the whole COVID-19 pandemic has been a difficult time for both consumers and for lenders, for everyone. So during this time, as you know, the Bureau handles consumer complaints and a little bit of information about complaint trends. In May, the Consumer Bureau handled 44,000 consumer complaints, and in June, 45,800 complaints. Both of these were the highest monthly complaint volumes in the Bureau's history. And in May, complaints that included COVID-19 related terms totaled about 8,000 complaints. Through May, mortgage, credit card, and consumer reporting topped the list for complaints that mention coronavirus terms, at 19% for mortgage and 18% each for credit cards and consumer reporting. So in response to the coronavirus pandemic, the Bureau has taken a number of actions to prevent financial harm, to help families who are struggling financially, and to provide guidance to the financial industry, so to ensure that their resources are aimed at assisting consumers in need. The Bureau established a centralized web page with information on how consumers can protect their finances during the pandemic, and on the screen you see the resources and tips for consumers, and that's sort of the one place, one-stop shopping that includes a number of steps that consumers can take if they have trouble paying their bills or meeting other financial obligations, if they experience a loss of income, or if they believe that they have been targeted by a scammer. In addition, the Bureau continues to engage with regulated entities, consumer advocates, state partners, and other stakeholders to ensure we are providing appropriate flexibilities during this time, including working with affected financial institutions in scheduling supervisory examinations to minimize disruption and burden, and temporarily providing flexibility in certain data reporting requirements. These and other flexibilities and guidance are available at the second link on the slide, the compliance and guidance information. Some of that compliance and guidance information includes information on the CARES Act and credit reporting. This is fairly significant. The Bureau has issued materials for consumers, for lenders who are furnishers under the Fair Credit Reporting Act, and to consumer reporting agencies about credit reports during the coronavirus time, including a blog about how consumers can protect their credit during the coronavirus pandemic, and also a policy statement and FAQs outlining the responsibility of credit reporting companies and furnishers under the CARES Act. The CARES Act requires lenders to report to credit bureaus that consumers are current on their loans if the consumers were not previously delinquent and received an accommodation from their lenders during the pandemic. The consumer blog and the policy statement and the FAQs are available on the Bureau's website. In addition, in March, the Bureau, along with the other federal financial regulators, released a statement encouraging depository institutions to offer responsible small dollar loans to consumers and also to small businesses in response to COVID-19. The policy statement mentions that small dollar loans can provide an important role in meeting consumers' credit needs due to a temporary cash flow imbalance, unexpected expenses, or income disruptions during periods of economic stress. Obviously, a number of people had income disruptions. And the statement also noted that these loans could be offered through a variety of structures, including closed-end installment loans, open-end lines of credit, or appropriately structured single payment loans. The statement noted that these loans should be offered in a manner that provides fair treatment to consumers, comply with applicable laws and regulations, are consistent with safe and sound practices, and also encourage depository institutions to consider workout strategies to help borrowers that needed them to repay the principal of the loan while mitigating the need to reborrow. In addition, under the CARES Act, payments due on federally owned student loans are suspended through the end of September 2020, and the Department of Education has stopped the collection of defaulted federal student loans, including wage garnishments and offsets of tax refunds and Social Security benefits. I wanted to mention a couple of other areas not specific to COVID-19, but which apply to consumer lending. One is that last December, in December 2019, the Bureau joined with other federal financial regulators to issue a joint statement on the use of alternative data in underwriting. That statement notes that benefits from using alternative data, such as cash flow, bank account data, may provide consumers expanded access to credit and enable them to obtain products on more favorable pricing and terms than they would otherwise obtain with the use of traditional underwriting. And then also in 2019, the Bureau issued 3 new revised policies to help promote innovation, including a revised no action letter, a revised trial disclosure program policy, and a compliance assistance sandbox. In May 2020, the Bureau issued a no action letter template to further competition in the small dollar lending space. That was issued to the Bank Policy Institute, and it would allow depository institutions to apply for a no action letter using the template that would cover their small dollar credit products up to $2,500. It's structured either as amortizing closed-end loans or lines of credit using cash flow underwriting, as mentioned in the alt data statement. Also with certain guardrails, including no rollovers and other provisions. So that's one of the other things that the Bureau has provided. Now, the trial disclosure program provides covered persons a safe harbor to test for a limited period of time disclosures that are designed to improve upon existing legally required disclosures. And the Compliance Assistance Sandbox provides companies a safe harbor to test innovative products and services for a limited period of time. All 3 policies require a review of the potential consumer risks and how the applicant intends to mitigate such risks. Finally, I will just mention briefly that last week the Bureau issued amendments to its 2017 small dollar lending rule, rescinding the mandatory underwriting provisions of that rule. So that's sort of a wrap up of the actions that the Bureau has taken in response to COVID-19 and even prior to that time in the area of encouraging greater access to consumer lending. I'll be happy to take questions later at the end of the other speakers' comments. Thank you very much.
Thank you, Laura. Our next speaker is Alex Horowitz. Alex is the Senior Officer for the Consumer Finance Project at Pew Charitable Trusts. In this role, Alex guides research for Pew's Consumer Finance Project, which focuses on how small dollar loans and consumer banking can be made safer and more transparent. Before joining Pew, Horowitz worked at polling firm Hart Research, and he also worked in media relations for the Florida Marlins and the Cincinnati Reds baseball teams. Go Reds. And he holds a bachelor's degree in sociology from Harvard University. Take it away, Alex.
Great. Thank you, Representative Koenig, and thanks to NCSL for having me here. So I'd like to talk about state issues with small dollar loan reform today. As Laura alluded to, there's a lot going on the federal front. I'll keep my comments pretty tight to state issues, though. I'm glad to talk more about the federal side in the Q&A. So a payday lending market, by way of background, we're talking about 12 million Americans using these loans every year. And the average borrower pays $520 in fees per year to repeatedly borrow $375 in credit. That's over the course of about 5 months of the year. The typical loan, meaning a 2-week loan, takes 36% of the borrower's next paycheck. It's going to be usually a somewhat smaller share for loans repaid in installments over more time. The typical borrower makes about $30,000 a year. So for somebody working full-time, 40 hours a week, That's roughly $15 an hour. So we're not talking about the poorest of the poor in society, but generally folks who are working. And we can certainly see from CFPB data and from our own nationally representative surveys of payday loan borrowers that the most common source of income for borrowers is employment. And borrowers must have a checking account. So the two requirements to get a payday loan are an income and a checking account. So we're talking about people who by definition are underbanked, not unbanked. So this is about 19% of households in the US who fall into that underbanked category according to the FDIC. And lenders can access the borrower's checking account generally on payday to collect. There are payday loan stores in 35 states, as well as stores offering auto title loans in in 24 in total. And there are 3 states that have auto title loans, but not payday loans. The payday loan market is not price competitive. That's not to say that it's not competitive, that lenders don't compete with each other. They do, but mostly not on price. Because when borrowers are in financial distress, and we can see this through a lot of the behavioral science research of the past decade, that when people are in distress, they focus on getting through the situation at hand. So speed, how fast can I get the money? Convenience, do I have to go through a complicated process in order to get it? And then certainty of approval, is it a sure thing? If I come and ask for a small loan, am I likely to get it, or might I get turned down and then need to go somewhere else? But this is what people focus on when they're in financial distress. As a result, you can see affordability and price are not on that list. And so as a result, lenders typically charge the maximum the state allows, whatever the maximum is. And in the 6 states that don't have price limits, they end up at the very high end of the price spectrum. So we see a wide variety in pricing across the country, even among the exact same companies, the exact same chains that operate in many states. So multi-state companies profitably charge 3 to 4 times less when states require it to similar borrowers, even though there's access in lower cost states and access in higher cost states with similar people borrowing and the exact same companies lending in many cases. So there's been a long running debate about is it better to have loans with 300, 400, 500% APRs, or is it better to have no credit at all? And frankly, that debate's been going on for a long, long time, certainly as long as payday lending's been around, which is about 30 years in its present form in the US. But that debate made sense at first before a lot was known about this market, and before states had tried out different ways of regulating this market. But now we can see that that debate is not based in reality. It's based in more of an expectation of what reality should be, that we'll either see very, very high prices or there'll be no credit at all, when in fact that's not the case. And there are other options out there. So Colorado's a nice example. In 2010, Colorado eliminated the conventional 2-week payday loan and instead required a 6-month installment loan. And that loan featured affordable payments. So the average loan now took 4% of the borrower's next paycheck instead of the 38% it took before that law went into place. These are amortizing loans with equal installment payments. That's a good thing. And Colorado, as a result, had the lowest payday pricing in the country. That's not to say it was low. APR still averaged 120%, including interest and fees, but an average loan of $389 was repaid in 3 months at a cost of $116. So that's about 3 times lower than it was before in Colorado, and it's about 3 times lower than it is in an average payday state. There were slight changes made in 2018 because of the ballot initiative, but the same lenders are largely still there, and there is still similar credit available, although the contours of the loans themselves are a bit different because of the 2018 ballot initiative. As you can see, stores were widely available after this Colorado law change, even though the industry had predicted otherwise. So the share of the population living within 20 miles of the payday loan store, before the law change, it was 93%, after 91%. The share within 5 miles of the store, before it was 82%, after 77%. And there are still stores widely available throughout the state after that law change. And there are stores open there today offering small loans to people with low credit scores. So using evidence to ensure access to credit but try to achieve better outcomes, the average payday loan state, and this is true today in the US, the cost to borrow $500 for 5 months is going to be about $750 at the price point of 15% per pay period, assuming someone's paid twice a month. Under the Colorado reform, where we saw widespread access to credit, $239, 3 times less. Share of paycheck is still quite high for those 2-week loans, much lower with that installment structure that Colorado was the first to implement. You can see APRs are lower and credit was still widely available there. So building on that, Ohio passed a law in 2018. It was bipartisan, though led by Republicans. And under that law, the cost to borrow $400 for 3 months. Before the law change, Ohio had just about the highest prices in the country. So the cost to borrow $400 for 3 months was typically more than $400 in fees and interest, and after 109. But there's still widespread access to credit in the state. About 175 locations, savings to consumers of more than $75 million per year, and several companies that were not in Ohio before the law change came in afterwards because there was a level playing field and it was easier to do business once there was regulatory certainty and a straightforward business model and straightforward rules. So we saw some new entrants into the market offering lower prices once the law came into effect. Now, lenders still charge the ceiling, but the ceiling is much lower and there's still credit widely available there. So Virginia, using Ohio and Colorado as a model, implemented a similar law. This past session, it takes effect this January 1st coming up. So the cost to borrow $500 for 4 months in Virginia prior to the law change was typically $480, after $138. So significant savings to consumers, and it uses an installment structure as well. And a number of lower cost providers that have previously avoided Virginia have stated they're going to apply for licenses and open up shop once the law takes effect. And they have a straightforward way to offer small installment loans. Again, the APRs on these loans are not going to be low. They'll be higher than credit cards, but far lower than what was in place before. So Ohio and Virginia both chose to maintain widespread access to credit. They didn't go the way of states that have eliminated these types of loans or never had them. They did it by reforming their payday lending statute and requiring installment payments, small payments over time, with each payment paying down part of the balance. So they both use an interest rate structure between 28 and 36%, but also have a reasonable monthly fee. So that means that the APR is going to be higher than that, but the pricing is viable for efficient lenders, and we'll see much lower prices under these laws as we have in Ohio. They both needed to touch other statutes in order to stop evasion, and required online lenders to get licenses, but welcomed online lenders to operate in these markets. States also have improved enforcement powers because loans issued without a license are void and uncollectible. States also have another way to make credit available to people with damaged credit scores at a lower price point, and that is by enabling banks and credit unions to offer small installment loans. At the federal level, we've seen very positive actions from the CFPB with their no action letter template, and from the OCC, Federal Reserve, FDIC, offering guidance to explain to depositories what's expected of them to offer small installment loans, because the price point where these loans are attractive to banks and credit unions is 6 to 8 times lower than average payday loan pricing. We've interviewed more than 100 bank and credit union executives on this topic, and states can expand access by enabling state-chartered depositories to offer these loans to residents who today are using payday and other high-cost loans. Those loans that would come from banks and credit unions, here's an example, a $400 3-month loan for a fee of $60 paid back over 3 months. 80% of Americans think that's fair. And it's 86% of payday loan borrowers who think that's fair. The fact that the APR is going to feel high and is higher than a credit card is not viewed as so important by the public or by borrowers. The benefit is that consumers can save hundreds of dollars by shifting to those loans if they become available. The view of a bank that offers this loan, 70% of the public says they would have a more favorable view, those 20% less favorable. So states have a role to play here by enabling state charter banks and credit unions to offer small loans on affordable terms that are attractive to providers. And my contact info is here. Thanks to Representative Koenig for moderating this.
Thank you, Alex, for that presentation. As a reminder, if the audience has any questions, please submit your questions by typing them in the chat box in the lower left corner of your screen. Wrapping up the formal presentations, we have Mary Jackson. Mary is the CEO of the Online Lenders Alliance, the largest trade association representing the industry of fintech companies that provide credit opportunities to consumers. She has also served as Senior Vice President of Public Affairs for Cash America International and in various leadership positions as a board member of the Community Financial Services Association and the National Pawnbrokers Association. Mary, thank you so much for joining us today, and the floor is now yours.
Well, thank you very much. I really appreciate being here today. I've spent 30 years in consumer lending and glad to share with you real-time data and give you some perspective on what I've seen over the years. But first, I'd like to thank the National Conference of State Legislatures for hosting this webinar. The panel participants and the webinar attendees, we're very honored to be here to share what we know about the non-prime consumer lending market. OLA represents over 150 members that include lenders, credit bureaus, data providers, advertising and marketing companies, as well as payments and innovation technology companies that make credit available to over 100 million Americans. And when we are looking at the consumer financial sector, many people think about banks and credit unions. But the financial ecosystem is much broader than that, encompassing fintech lenders, installment lenders, marketplace lenders, title lenders, pawn shops, and more. So for instance, mainstream financial institutions like banks and credit unions do a really good job serving those who have excellent credit. But who is serving the riskier borrowers? It is primarily the non-bank sector, which are companies that serve the non-prime consumer. In fact, I was once a non-prime customer who struggled to obtain credit from traditional lenders. And fortunately for me, an alternative lender took a chance on me, and I was able to build my credit. So consider the fact that 40% of U.S. adult population are non-prime, meaning they have a FICO score under 700. Having access to a non-bank lender is essential. It may not be surprising, but I think it is worthwhile pointing out that the people with FICO scores above 680 rarely get rejected when applying for credit. In contrast to individuals with FICO scores below 680 experience rejection on a much more consistent basis. Much of the data presented today is from last year during an economic expansion, so rejection rate is likely much higher today than it was last year. So let's talk about our loan products. I'd like to highlight the type of loans that consumers are using in the non-bank sector because I think the details are important. Too often there is discussion about payday loans, which are short-term loans that are designed to be paid off during the consumer's next payday, typically within 2 weeks. Payday loans, both online and storefront, have declined substantially over the last 5 years. Instead, people are gravitating towards longer-term, fully amortized installment loans that provide consumers more flexibility in paying off their loans. Many of these offerings provide credit-building features that are critical in helping non-prime consumers. Installment loans and lines of credit are offered largely by OLA members, and the average loan amount is usually somewhere between $800 and $1,000. As for other lending products, there's been a similar decrease in the usage if you compare it to rent-to-own, title loans, pawn loans, overdraft fees over the last year. So as you see, these are trending downwards. You're seeing installment loans trending upwards. But it's been reported that pricing, affordability, and the structure of the installment loans are more consumer-friendly than those of other non-prime credit products. So what's been happening in this sector during COVID? Well, online lending companies, we've seen the consumer demand for loans decrease, and they've decreased considerably. So if you look at the chart here, it decreased about 70% from late February to May. It's recovered a bit since then, but it's still nowhere near levels we saw pre-COVID. So the decline in loan demand is primarily because consumers are reacting to the crisis by reducing their spending and saving their money, demonstrating some financial responsibility, which is good. Federal and state actions, including the stimulus checks, extended unemployment benefits, have eased the pressure on many struggling households. All lenders are tightening their lending standards and modifying their ability to repay underwriting criteria. As you might have seen in the press this week, the largest banks are bracing for large losses amongst prime consumers, and our lenders are preparing for the same. As banks and credit unions are trending down, the Philadelphia Federal Reserve released a study last week showing that new account originations fell across the risk spectrums in April, with the most pronounced contractions amongst the riskiest borrowers. So once again, the non-prime consumer will be highly impacted with less access to credit. And what about the consumers with existing loans? Well, lenders have made numerous efforts to assist customers, including enacting loan forgiveness and loan forbearance programs, freezing the interest payments, or deferring or skipping payments, doing extended payment plans, waiving the fees, including the late fees or return items, and halting collections activities. Our lenders report that 20 to 50% of their customers have requested a loan modification, which they are granting because everyone is in this together. Further data shows that non-prime consumers have seen a reduction in net debt during the COVID-19 before the crisis. Oops, sorry, I've got my slides mixed up here. And 70% of non-prime respondents had more debt than savings. So in May, that number dropped to 62%. This trend may reverse as federal and state programs designed to help people and companies weather the crisis wind down over the next few months. So as Laura mentioned, the CFPB Consumer Complaint Database, I did put up a slide here just to show that, in fact, there have been a number of complaints in the last 4 months. But when you really look at the personal loan space that includes installment loans, it's just over 1% of all the complaints. And since Representative Koenig is on the phone and our host, Kentucky, they do a state level data, and only 18 complaints came from Kentucky, and they only had 1 complaint about an installment loan. So again, this is data from March 15th through July 13th, so roughly 4 months of data, and again, very timely. I'd like to talk about interest rate caps, which are limits on how much a lender can charge for a loan. And OLA believes that rate caps are detrimental to the non-prime consumer because it denies access to regulated, safe credit if the rates are set too low. As a matter of fact, there are states like Delaware, Idaho, Nevada, Utah, Wisconsin, and some loan types in Texas that do not have rate caps. And federal institutions do not have rate caps. That is why the U.S. Bank Simple product is priced higher than 36% APR. Many independent economists have discovered that rate caps tighten the supply of credit. A 2018 World Bank study found that while some forms of interest rate caps can indeed reduce lending rates, it also has negative effects such as increases in fees, which reduces price transparency, lowers the credit supply and loan approval rates for small and risky borrowers, lowers the numbers of institutions, and reduces branch density, as well as adverse impacts on bank profitability. And we've already had reviewed that banks do not serve riskier borrowers. So many are told that the Military Lending Act is good policy as it has imposed a 36% rate cap for military service members to protect them from involuntary separation from service due to debt problems. This law was implemented in 2006 and expanded in 2017. But it is a good policy. Independent research demonstrates that it is not. A Harris poll was conducted among military service members in both 2014 and 2019. So we can see how MLA expansion impacted our military. In 2014, 2% of service members believed that the lack of access to credit worried them the most. That number doubled to 4% in 2019. In 2014, about 3% of the respondents were getting calls from collectors and struggling to pay their bills each month. 5 years later, that number was 8%. These numbers may appear small as percentages, but each percentage point represents more than 10,000 service members. And from the chart on your screen, you can see that our men and women in uniform are much worse off today than they were in 2014 in a variety of ways. A poll in 2019, this time by Harris X, found that a majority of military households have been denied loan products and access to credit because of MLA and its 36% rate cap. As a result, military service members were more likely to use inferior credit products, which had a real impact on their financial well-being. And another independent 2017 study by the U.S. Military Academy at West Point found that service members' access to short-term small dollar loans had positive impacts of access and may actually have decreased the probability of being involuntarily separated from the Army by 10%. So as you can see, interest rate caps simply restrict access to credit, but there is not corresponding reduction in the need for credit. So non-prime consumers who use higher interest rate loans do so because they're denied by prime institutions. All studies show that non-prime consumer choices become constrained and limited them to a smaller pool of financial service providers and heavily use overdrafts and increases in late bill penalty payments and bounced checks. And as to the recent states that have changed their laws, we'd like to do a comparison and an update. First, Ohio and Virginia law changes allowed for a 60% and 41% APR respectively. When we look at the U.S. bank product that's currently in the market, it is 71% APR. In order to receive a U.S. bank loan, you must be an existing customer and you must have direct deposit. So U.S. Bank has very large operational advantages than our lenders. So we would encourage states to research the economics of lending before restrictive pricings lead to prohibition. As other studies have shown, it's become a reality for Ohio. Before the implementation of Ohio's new law at 60% APR, there were over 1,000 licensees. Now there's only 175 licensees with more closings to be announced. So prices set too low do constrict access and choice. With COVID, borrowing conditions have worsened for the non-prime consumer. It is important to remember that the vast majority of states continue to allow some form of lending above 36. This helps ensure that millions of Americans with less than perfect credit can pay bills and are not shut out of credit alternatives. And the last thing I'd like to mention is that OLA members and other financial service providers already abide by 19 federal laws and regulations, which will soon include the recently finalized CFPB small dollar rule. Our members also abide by all applicable state law, NACHA rules that govern the ACH payment systems, and OLA's industry best practices, which often go above and beyond federal laws and regulations. So OLA believes in well-regulated lending markets that support financial inclusion, credit building, and innovation that can benefit Americans who are typically shut out from improving their financial health. So with that, I thank you, and I'd be happy to take any questions.
Thank you, Mary, for wrapping up our presentations. We have about a little less than 20 minutes or so for questions. A few questions that have been submitted. Don't forget, if you have a question, please type it in the audience chat box on the left. As a reminder, this webinar is being recorded and will be made available to participants. Any questions not answered on today's webinar will be answered via email. I think Mary did a great job of leading me into a first question from Laura. Laura, can you describe what the Bureau did in its July 7th actions on the 2017 small dollar rule and how it will affect states?
Sure. So some of you may be aware of this, but the 2017 small dollar rule had two parts. The first part that received probably the most attention was on what was called at the time in 2017 an ability to repay requirement. Now we have sort of rebranded or renamed it as a mandatory underwriting provisions. The second part of the rule had a section on payments provisions. So what the Bureau did last week in its July 7th final rulemaking action was to rescind the mandatory underwriting provisions or the ability to repay provisions after reevaluating the legal and evidentiary bases for those provisions and finding that there was not robust and reliable evidence and support for those provisions. So those mandatory underwriting provisions were rescinded. The final rule still needs to be published in the Federal Register, and the rescission of those mandatory underwriting provisions is planned to go into effect 90 days after publication in the Federal Register. The final rule did not rescind, and we did not propose to rescind the payments provisions. So the payments provisions remain. There was litigation and is pending litigation, but the payments provisions prohibit lenders who make certain covered loans from making a new attempt to withdraw funds from a borrower's account where 2 prior consecutive payment attempts have failed without obtaining an additional authorization from the consumer, and there are certain notices that have to be provided. The other part of the question, though, was how does the Bureau's action last week affect the states? And it does not, is the short answer. Approximately 32 states currently allow short-term small dollar lending for their residents in the payday sphere. And many of those states set maximum interest rates and have other lending restrictions. As before, states continue to have the ability to establish limitations on small dollar lending as they deem appropriate for their residents. You heard Alex mention some slightly, I think, different numbers. Some of that depends on how you count the number of states that authorize payday or small dollar lending. Some of them do it expressly, others have no rate caps. But generally, the answer is the rescission of the mandatory underwriting provisions does not in any way impede states from setting their own restrictions, maintaining existing restrictions, or adding new restrictions, or determining whatever course they choose for their own state residents in the small dollar lending space, other than, of course, the payment provisions as they remain in effect.
Great. Thank you, Laura. We have a couple audience questions directed for Alex. Alex, you talked about availability of credit. Is the data for availability of credit studied on the same consumer base before and after, or just location?
Thanks. That's a great question. So the availability of credit is studied on the same consumer base. And thankfully, Colorado did a nice job of collecting data from consumers. So we could look at customers before and after the law change and see if they were the same, or if the product moved upscale. And we can see, in fact, that they are the same in terms of mean income, median income, age, average time at current job, gender, marital status. And we also interviewed lenders in the state and asked if the product had moved upscale or not. They reported that it generally had not, which makes sense because what we see in markets like this is that there's a relatively fixed pool of customers at any given time that have low enough credit scores and are in enough financial distress that they'll seek out a product like this. And the customer base essentially stayed the same in Colorado. We've also interviewed some lenders in Ohio about that and have not seen the product move upscale, probably for the same reasons. But we have interviewed lenders about that to confirm that we're essentially seeing similar borrowers who lenders often describe as having kind of D or F credit who are using the product. So it is the same customer base, in fact.
Okay, and I said I had 2 questions, but I'm going to make this question 1A. You talk about, well, kind of the dovetail with what Mary mentioned with regards to Ohio. You said that, you know, credit was still available in your presentation. Mary said that after they enacted the law, gone from about 1,000 to 175 locations. Do you consider that to be the same, adequate, or what? How would you describe that?
And I think, I will talk about Ohio. Let me use Colorado first, just because they collected comprehensive data before and after the law change. So it's a really nice apples to apples. Because Colorado also saw a lot of store closures in the state, but what happened is the number of customers per store doubled. So stores became much more efficient. There's a common misperception that payday lenders, especially through brick and mortar, use most of their revenue to cover losses. And that's not the case. For a typical payday loan store, about 2/3 of revenue goes to cover overhead. And their overhead, the entire overhead of running a retail operation, is spread over about only 500 unique borrowers per year. The average title loan store only serves 300 unique borrowers per year with title loans. So that's a lot of overhead to carry to operate an extremely inefficient business. In a price competitive market with price sensitive consumers, we would see that excess get competed away. But that doesn't happen in this market because opening more stores is an effective customer acquisition tool. So while in a typical payday loan state, store serves 500 unique customers per year, in Colorado, it's 1,100. And that efficiency enables much lower prices. Ohio also made another change, which is that they had never authorized title loans, but title lenders had come into the state anyway, essentially operating as brokers. And the legislature chose on a bipartisan basis to stop that because they had never authorized title lending. So a lot of the closures there were stores that either exclusively offered title loans or a major line of business from them was title loans. And we saw several online lenders open in Ohio, but following the rules, getting state licenses. And I know Mary mentioned a 60% APR cap in Ohio. That's not what they've done though. They use a 28% interest rate plus a monthly fee up to $30. So the APRs on those top out around 200% for loans up to $300, and they decline steadily as loan size goes up until they hit 88% for $1,000 loans.
All right, I appreciate that. And I got one more question for you, Alex, and then Mary, I've got a question for you, and you can maybe respond to a little bit of that if we have time. Alex, do you know why lower cost providers avoided Virginia before the law change?
Sure. So Virginia, prior to the law change, had authorized very high cost loans, but only if they were offered in a certain format. And small installment loans had a hard cap of 36% interest, inclusive of fees. And that was not a high enough price point for them to offer small installment loans. So lenders that use an installment loan format were not able to operate in Virginia. And essentially the landscape was also so cluttered by very high cost loans, often made using an open-end structure because Virginia had an open-end provision in their law, which had no rate limits at all. And so open-end lenders tended to charge interest rates of 299 to 360% plus fees on top of that using the open-end structure. Once there was a level playing field and small installment loans above 36% were authorized, lower cost lenders were very interested in operating in Virginia because now they were authorized to do so And I know there was a mention of a number with a rate limit in Virginia, but that's not the case. APRs top out in the 170s in Virginia for loans up to about $300, and they decline steadily until they get into the mid double digits for loans up to $2,500.
All right, well, I appreciate that. Mary, we have 5, maybe 6 minutes. I wanted to ask you a question, and then if you'd like to take a minute or two to respond to some of that, that'd be fine. You talked about service members, the caps on their loans, and you talked about some of them not having access to credit. So if you're a military person, you don't have the access to credit that you feel you need at that point, what other options do these military folks take?
Well, there are military relief societies that do really a low-cost payday loan at up to $500. But again, it's a very intense process that you have to go through. So service members do take advantage of them, which is good. But again, their financial lives should have shown some improvement based on the data that was collected from West Point as well as from some of the other surveys. So we haven't seen that. I think as we see in most cases when access to credit has been stymied, they'll just be paying their bills late. They'll seek overdraft, which then puts your bank account in jeopardy of losing that account if you can't keep up with the overdraft charges. So again, it kind of defaults back to really not having access to credit and just using some of these other financial tools.
Okay. Any thoughts about question or answers to the questions Alex had?
Well, it's, we can debate APRs and pricing all day long, but I think when you look at what happens in the market, a lot of lenders who back the lower cost proposals, they are seeking competitive advantages. We saw that in California where your traditional finance companies supported restricting the price point so they could take advantage of that. But they're not going to underwrite everybody that was seeking credit or obtaining credit in the market. They're going to cherry pick the top of the heap and leave many customers that are denied for credit. And the same will be true for the lenders that take advantage of, what's left over in Virginia and Ohio. And I think there's got to be more study. I think it's great that we have all kinds of experts and data pieces, but there's more to the story than that. There's more competition coming now from the banks. So if U.S. Bank is doing it 71%, again, like I said, with their operational advantages, there's other banks that are also competing for this customer. Maybe they'll fill the void, which will be a good thing, but those products are, somewhere at 150 to 175. Some of them have gone lower depending on the risk profile of a consumer, and we are seeing more stickiness when it comes to risk-based pricing. Not everybody's getting the same price. But I guess the question for today is, how do states stay competitive with all the financial fintech that is getting pushed into the marketplace? How do you keep storefront lenders and other folks that are based in your state from being competitive? And I think that is really up to the legislative bodies to take a look at various sources of information. I think Alex does a great job with his information, but I think there's some other pieces that are lacking to be able to make an informed decision. So there is so much on the market right now. The prices have come down over time, and that is encouraging. I think there's got to be more transparency for consumers being able to shop for the best deal. I think sometimes we're lacking in that. They do need a wider range of borrowing too. Some of the laws that are passed of you can only get a loan up to $500. In some states, it's only $255, and we're finding the demand out there is much higher than that. So, if you're only allowing a $300 payday loan and somebody really needs $600 to get a car repaired, is that option available? I think terms, if you're talking about installment loans, you have to look at the pricing and compare it to really what the banks are offering to this market. And again, they're only offering it to existing consumers. And then, we really do have to have transparent pricing. When you add on fees you add on all these different fees and you try to do the calculation, it's really mind-boggling. A lot of companies do add-on products that add to the cost of your loan and products you really don't need. So again, I just think that there's got to be more transparency in the pricing and all the chutes and ladders that we've seen in some of these recent proposals with, 36% plus this fee, plus that fee, this amount, that amount. If you go above this, you can do this. I just think it's just not very transparent. I think consumers get confused. So.
Great, thank you. We have about a minute left, and we have one final audience question. I think Alex might be the best to answer it, but if someone else has an answer, we're open to that. Has there been any studies in the states that have enacted rate caps that has expanded or limited money available for consumers that have less than 500 FICO scores?
Sure, this is Alex. Yeah, there have been. I mean, we've done several, and we're not the only people who have done them. But I think it's worth noting, I mean, not all interest rate caps are the same. So it depends where you set them. The World Bank study that Mary cited, that was about low interest rate caps that are binding, that constrict access to credit. So if a state sets a low interest rate limit and there's not enough revenue to provide a loan, then it shrinks access to credit. If they set an interest rate cap based on evidence and they want credit to be widely available, but at prices 3 to 4 times lower for consumers, they can do that too. So Ohio, Colorado, and Virginia all got it right. They all set rate caps, but they set them at a level where there'll be access to credit available. And there are 15 states that have chosen not to have payday loans, and that's a reasonable policy choice to make. If you set rate caps at a low place, then that type of credit isn't available. If you don't set them at all, or you set them very high, there's not a corresponding increase in access. Your residents just get charged a lot more.
Terrific. Well, I guess if you want to find some of those studies, you can go to Pew Charitable Trusts and maybe look them up otherwise on the web. That concludes today's webinar. I want to thank our presenters again for sharing their time and expertise on today's webinar. And thank you to our audience for taking the time to participate in our webinar this afternoon. The archive of today's webinar will be posted on NCSL's website. To find the archive, go to ncsl.org, click on the COVID-19 resource page, and select the webinar tile. Don't forget about the third webinar that it will be, I believe, on the 29th, we said. And otherwise, we appreciate everyone's participation and have a good day.